Every money laundering tactic explained for legal analysis. You review common laundering typologies to understand how placement, layering, and integration manifest in practice and how legal systems counter them through reporting, supervision, and prosecution. You treat each mechanism as a compliance and enforcement problem, not a playbook, and you translate typologies into risk indicators, internal controls, and evidentiary checklists. You proceed for prevention, detection, and lawful reporting obligations. Footnote. This section frames your inquiry as a compliance-focused analysis that converts typologies into lawful detection and control strategies. Placement via casinos. You analyze the chip conversion pathway where cash is exchanged for chips, limited gambling activity creates a veneer of legitimacy, and redemption produces an instrumented payout. You recognize modern countermeasures such as customer due diligence, transaction monitoring, and suspicious activity reporting that target minimal play and structured chip cash outs. You counsel that records of buy-ins, table activity, and redemptions are probative in administrative and criminal proceedings. Footnote. This section explains casino-based placement and the corresponding surveillance, record-keeping, and reporting tools used to disrupt it. Structuring and smurfing. You consider distributed cash deposits designed to evade thresholds and monitoring by fragmenting funds across institutions, days, and locations. You note that liability arises from intent to evade reporting requirements, not merely from the amount, and you emphasize pattern analytics that detect repeated sub-threshold deposits, coordinated timing, and common controllers. You advise comparing behavior to peer baselines rather than to a single fixed number. Footnote. This section describes structuring risk and highlights how pattern detection and intent evidence defeat sub-threshold tactics. Integration through cash-intensive businesses. You evaluate the commingling of illicit cash with legitimate receipts using enterprises that reasonably generate currency. You test reasonableness through capacity, foot traffic, inventory purchases, utilities usage, labor hours, and third-party data. You recognize that sustained overstatement of sales, implausible customer counts, and cross-promotion loops can reveal artificial revenue. Footnote. This section addresses how you test claimed cash revenues against operational reality to detect commingling and false sales. International layering by wires and corporate hops. You assess rapid multi-jurisdiction transfers that create volume and legal friction, often through investment accounts and paper entities. You rely on beneficial ownership inquiries, treaty-based requests, and flow of funds charts that reconcile dates, amounts, and counterparties. You treat circular flows and short holding periods as red flags and preserve metadata to corroborate control. Footnote. This section outlines multi-border layering and the evidentiary tools you use to reconstruct ownership and control through time. Trade-based laundering. You examine over-invoicing, under-invoicing, multiple invoicing, phantom shipments, and misclassification. You compare declared values to reference prices, inspect bills of lading and packing lists, and test shipping routes and weights for plausibility. You coordinate customs, tax, and banking records to align value, volume, and payment timing. Footnote. This section shows how you match trade documents to economic reality to expose value transfer disguised as commerce. Real estate value manipulation. You review property acquisitions with opaque funding, rapid flips among related entities, and inflated construction draws. You analyze appraisals, liens, permits, change orders, and closing files to separate legitimate appreciation from engineered price lifts. You trace beneficial owners through layered vehicles to determine true control and source of funds. Footnote. This section details how you test property pricing and ownership structures to identify laundering through real assets. Shell companies and offshore accounts. You confront nested entities that obscure beneficial owners and disperse records across jurisdictions. You require verified ownership attestations, examine nominee arrangements, and model control through signatory rights and shared infrastructure. You treat frequent restructuring and looped ownership as indicators of concealment rather than ordinary tax planning. Footnote. This section explains how you pierce formal separateness by proving effective control and tracing signatory authority. Digital currency typologies. You consider conversion of fiat to digital assets, hops across wallets and exchanges, use of mixers, and privacy-preserving assets. You emphasize on- and off-ramp due diligence, blockchain analytics, address clustering, and sanction screening. You distinguish legitimate trading from obfuscation by examining velocity, path complexity, and counterparty risk. Footnote. This section frames crypto-related methods and the analytics you deploy to attribute activity and identify obfuscation. Institutional complicity risks. You assess scenarios where gatekeepers fail through negligence or collusion, including weakened controls, correspondent channel abuse, and third-party processors. You stress governance, escalation discipline, and independent testing. You document willful blindness and remediation failures as aggravators in enforcement. Footnote. This section addresses the control environment, emphasizing governance failures and correspondent risks that can enable laundering. Alternative remittance networks. You analyze trust-based value transfer systems that settle through netting and trade offsets rather than formal banking. You focus on typological indicators such as tight-knit broker clusters, rapid cross-border balancing, and price anomalies in related trade flows. You coordinate community outreach with lawful enforcement to distinguish legitimate remittances from criminal abuse. Footnote. This section discusses informal transfer systems and the lawful indicators and outreach needed to separate licit from illicit use. Professional laundering services. You recognize specialized firms that sell end-to-end laundering, leveraging sector expertise and layered fronts. You map their service stack, isolate choke points, and pursue conspiracy and aiding counts alongside primary offenses. You expect multi-client flows, standardized documentation, and fee patterns that reveal enterprise-level activity. Footnote. This section identifies professionalized laundering as a service and the prosecutorial and compliance responses it triggers. Prevention, detection, and cooperation. You translate typologies into risk assessments, customer diligence, monitoring models, and case management. You use machine learning with human review, share information within lawful channels, and escalate promptly. You memorialize decisions, file reports when warranted, and support cross-border cooperation consistent with privacy and due process. Footnote. This section converts understanding into program design, emphasizing controls, documentation, and lawful information sharing. Conclusion. You treat laundering as a dynamic contest between concealment and accountability. You avoid glamorizing methods, you refuse operational detail, and you focus on lawful disruption. Your professional charge is clear. Build controls, read patterns, preserve evidence, and report. By doing so, you protect markets, clients, and the rule of law. Footnote. This section closes by centering ethical purpose and legal obligations, committing you to prevention, evidence, and reporting.